California is entering one of the most complex tax environments the state has seen in nearly a decade. In 2026, a combination of federal legislative changes, state-level policy shifts, and a proposed ballot initiative are reshaping the tax obligations of millions of residents. The changes affect homeowners, wage earners, retirees, small business owners, and the state's wealthiest individuals, though in different ways and to different degrees. What follows is a factual overview of what changed, what is still under debate, and who is most directly affected by the new landscape. The first and most broadly felt change involves a federal adjustment known as the state and local tax deduction, commonly referred to as the SALT deduction. Since 2017, federal law had capped the amount taxpayers could deduct for state and local taxes paid at $10,000 per year, regardless of how much they actually paid. For residents of California, where state income taxes are among the highest in the country and property values routinely produce five-figure annual tax bills, this cap created a significant burden. Many residents found themselves paying taxes at the state level on income that was also being taxed federally, with no meaningful deduction to offset that overlap. That changed when the One Big Beautiful Bill Act was signed into federal law on July 4, 2025. Under that legislation, the SALT deduction cap was raised from $10,000 to $40,000, retroactive to tax year 2025. This means the higher limit applies to the returns that California residents are filing in 2026. For a homeowner in the Los Angeles area paying, for example, $15,000 annually in property taxes and an additional $20,000 in California state income tax, the prior cap of $10,000 made the difference between those payments largely irrelevant at the federal level. Under new cap, a much larger portion of that combined $35,000 payment becomes deductible against federal taxable income. According to federal guidelines, the benefit is structured with a phase-out mechanism. For taxpayers with a modified, adjusted gross income above $500,000 in the 2025 tax year, a threshold that rises to $505,000 for 2026, the cap begins to reduce. The reduction is calculated at 30% of the income that exceeds the threshold. At a modified, adjusted gross income of approximately $600,000 for a single filer in 2026, the cap reduces back toward $10,000. This design means the full $40,000 benefit is most available to upper-middle-income households, while very high earners may see a significantly smaller deduction. The cap is also set to increase by 1% per year through 2029, after which it is scheduled to revert to $10,000 under a sunset provision in the current law. Tax analysts have noted that this change affects California more than most other states, precisely because of how high state and local taxes already are. Residents who previously had no reason to itemize their federal deductions because the standard deduction exceeded what they could claim may now find that itemizing produces a lower federal tax bill. The standard deduction for 2025 was $15,000 for single filers and $30,000 for married couples filing jointly. With $40,000 in SALT now potentially deductible, many California households will need to reassess whether itemizing or taking the standard deduction is more advantageous. The second major change involves California's state disability insurance program known as SDI. This program provides partial wage replacement to eligible workers who are unable to work due to illness, injury, or pregnancy, and it is funded through employee payroll deductions. Starting in 2024, California eliminated the wage ceiling that had previously limited SDI contributions. Before that change, workers only paid SDI tax on the first portion of their earnings, up to a defined cap that had been around $150,000 in earlier years. Once a worker's earnings reached that cap during the year, SDI contributions stopped for the rest of that year. The removal of the wage cap means that all wages, regardless of total annual income, are now subject to the SDI tax. In 2026, that rate is 1.3%, up from 1.2% in 2025 and 1.1% in 2024. For a worker earning $500,000 annually, this translates to $6,500 in SDI contributions for the year. Under the old system, with a wage cap, that same worker's contribution would have been approximately $1,400. The difference represents a substantial increase in payroll costs for high earners, and it has also affected how some business owners structure their compensation, since SDI applies specifically to wages, rather than to distributions from business entities such as S corporations. California also maintained its position as the state with the highest marginal income tax rate in the country. For 2026, the top state income tax rate remains 13.3%, applicable to taxable income exceeding defined thresholds for different filing statuses. When combined with the highest federal income tax bracket of 37% and the federal net investment income surtax of 3.8%, which applies to investment income for individuals above certain income thresholds, the combined marginal rate on certain types of income can exceed 50% for California's highest earners. This is particularly relevant for capital gains. Unlike the federal tax system, which applies preferential rates of 0, 15, or 20% on long-term capital gains, depending on income level, California taxes all capital gains as ordinary income. There is no distinction under California law between a gain on an asset held for 1 year versus one held for 20 years. Both are taxed at the same progressive rates as wages and salary income. For a California resident who sells a business, a piece of real estate, or a large equity position in a company, the state-level tax on that transaction can be substantial. A technology professional in the San Francisco Bay Area with a base salary of $300,000 who sells company stock for a $1 million gain, for example, would see their total taxable California income jump to $1.3 million for that year, potentially placing the entire gain at the highest state tax bracket. This structure has implications for estate planning and for decisions about when to sell appreciated assets. Tax advisors working with California clients have noted that the interaction between California's capital gains treatment and the federal system creates a combined burden that residents of most other states do not face. States such as Texas, Florida, and Nevada impose no state income tax at all, which means the same capital gain would carry only federal tax liability in those states. Alimony treatment also changed at the start of 2026. For divorce or separation agreements signed after December 31, 2025, California will now conform to federal standards. Under the new rules, individuals who pay alimony can no longer deduct those payments from their taxable income, and individuals who receive alimony are no longer required to report it as taxable income. Agreements signed before that date are generally grandfathered under the prior rules, meaning the payer could still deduct those payments and the recipient would still report them as income. California's Franchise Tax Board indicated that individuals will be required to report the month and year of their divorce or separation agreement on tax filings beginning with the 2025 tax year in order to determine which set of rules applies. For small business owners operating through pass-through entities such as S corporations, limited liability companies, and partnerships, 2026 brought the permanent extension of the qualified business income deduction at the federal level. This deduction, commonly called QBI, allows eligible business owners to deduct up to 20% of their qualified business income from federal taxable income, reducing their effective federal tax rate on that income. The permanence of this provision was confirmed through the One Big Beautiful Bill Act. However, California does not conform to this deduction, meaning California business owners receive the benefit only on their federal returns and not on their state filings. This divergence between federal and state treatment increases the complexity of tax filings for pass-through business owners operating in California. California also extended its pass-through entity elective tax through 2031. This mechanism allows eligible partnerships and S corporations to pay state taxes at the entity level and claim a corresponding credit on personal returns. It serves as a workaround to the federal SALT cap for business owners, since entity-level state taxes are generally deductible as business expenses without being subject to the same individual SALT limitations. The extension of this program through 2031 was noted as a relevant planning tool in analyses published by the California Franchise Tax Board and various tax advisory firms. For residents aged 65 and older, the federal legislation introduced a new senior bonus deduction of up to $6,000 for individual filers and $12,000 for married couples filing jointly. This benefit phases out at adjusted gross income above $75,000 for single filers and $150,000 for joint filers. For seniors with incomes below those thresholds, the deduction represents additional federal tax relief. California, however, does not conform to this federal adjustment, meaning the benefit does not apply to state tax filings. California continues to fully exempt Social Security benefits from state income tax, which remains a distinguishing feature of the state's tax code relative to some other states that tax retirement income more broadly. The most politically contentious development in California's 2026 tax environment involves a proposed ballot initiative known as the California 2026 Billionaire Tax Act. The measure, which was in the signature-gathering phase as of early 2026 and would require approximately 874,000 valid signatures to appear on the November 2026 ballot, proposes a one-time 5% tax on the worldwide net worth of California residents with assets exceeding $1 billion as of December 31, 2026. According to an expert report published jointly by researchers at UC Berkeley, UC Davis, and the University of Missouri in December 2025, the measure would affect approximately 200 individuals in the state. Revenue collected under the initiative would be directed 90% toward healthcare and 10% toward education and food assistance programs, according to the text of the initiative. The proposal is being advanced by the Service Employees International Union, United Healthcare Workers West, and is supported by Congressman Ro Khanna. It has drawn opposition from California Governor Gavin Newsom, who publicly stated that such measures are, in his assessment, not viable given competition from other states with lower tax burdens. Newsom has also pointed out that California already relies heavily on a narrow base of high-income earners for a significant portion of state income tax revenue. Data from state officials indicates that roughly half of California's personal income tax collections come from the top 1% of earners. The potential departure of high net worth individuals in response to a wealth tax is a concern raised by several economists and business groups, including the California Business Roundtable. Billionaire and Palantir co-founder Peter Thiel has reportedly directed $3 million toward opposition efforts, according to reporting by Kiplinger, published in January 2026. Supporters of the measure dispute the relocation concern, citing research data suggesting that wealthy individuals do not generally move in response to one-time tax events. The initiative's structure as a single levy, rather than an ongoing annual tax, is explicitly described by its proponents as a design choice intended to reduce incentives for avoidance through relocation. The measure also includes provisions that define California residency as of January 1, 2026, meaning individuals who moved out of the state after that date would still be considered subject to the tax for purposes of the initiative should it ultimately pass and be upheld in court. Legal analysts from firms including Baker Botts published assessments in late 2025, noting that the measure would face significant constitutional challenges related to due process, the Dormant Commerce Clause, and the retroactive nature of using a residency determination date that precedes the election itself. The California Constitution currently caps taxes on certain intangible property, which means the initiative also includes a constitutional amendment provision. Any legal challenges would likely extend the timeline for collection, even if voters approved the measure. The question of how to value assets for purposes of the wealth tax has also been raised by analysts. Stakes in private companies, venture capital funds, intellectual property, and other non-publicly traded assets do not have a readily available market price, creating potential disputes between taxpayers and the state over assessed values on the December 31, 2026 valuation date specified in the initiative. As of February 2026, the SALT deduction increase and the SDI rate adjustment are both in effect for the current tax year. The senior bonus deduction applies at the federal level. The alimony rule change applies to agreements signed after December 31, 2025. The QBI deduction is permanent federally, but does not apply at the California state level. The pass-through entity elective tax has been extended through 2031. The Billionaire Tax initiative remains in the signature collection phase and has not been confirmed for the November 2026 ballot. If it does qualify, California voters will decide its fate later in the year, after which legal proceedings would likely begin before implementation. California's Franchise Tax Board has encouraged electronic filing for the 2026 tax season, which officially opened on January 7, 2026, according to the board's published guidance. The agency has also noted that the interaction between federal and state conformity rules, particularly the areas where California does not adopt federal changes, creates a filing environment that is more complex than in prior years. Further developments are expected as the signature gathering process for the Billionaire Tax initiative concludes, as the state legislature responds to the fiscal implications of federal tax changes, and as the November 2026 election approaches. Independent verification of the initiative's ballot qualification status and ongoing legal analysis of the federal conformity questions are both pending as of this report.